Yep.
All right, everybody. It is Wednesday. We're coming to you live. Some of you all are listening to the podcast later on. Welcome all. So today we're going to talk about your actual stock portfolio. Do you know what's in it? Do you know why you bought it? Do you know the percentage of a particular stock has in your assets or in your portfolio? Meaning, do you know your asset allocation model and also how much one stock may account for your overall portfolio size? We're going to talk about that today. And actually, let's just go real basic. Do you know what's in it? Sometimes we forget. So we're gonna discuss it right now. Is a great time if you're thinking, oh, well, let me pull up my account. Let me take a look at my portfolio. You know what? I don't know. Or let me go through it while they're talking about it. Leon's going to tell you why we chose this topic while I do some housekeeping.
Yeah, I chose this because the topic today was going to be ETFs, but I chose this today because typically I check out my portfolio, I don't know, once every to look at my individual positions. I actually don't look at. I look at my overall portfolio. But I was looking at it. I was going through something today, doing some research, and I came across the DRI. So Darden Restaurants. The ticker symbol is DRI. I bought them back in February, right before COVID hit. And when COVID hit, I knew I was down big in the stock. Like I knew, the market had fallen apart. And of course, Darden being owner of restaurants, they own things like Olive Garden, Bahama Breeze, Longhorn Steakhouse, some names you might know. But they were hit because it's inside dining, and I knew I was down big. So I wasn't even worried about it, and we're going to read later why I wasn't worried about it. But just going across the chart last night, I saw that I was almost back to even, and I was like, wow, it's great. So I thought this would be a good lesson in why when I was down so much, I didn't really even care, and it didn't affect me in any way, shape, or form. And we're going to see that I was down big, like I was down huge, massive, like I mean a almost 100%. Let's just say that, and we're going to it in a minute. But I was down huge in this position. While I knew I was down huge, like I said, it didn't really affect me or nor my portfolio. And then when I saw it was back to even, almost back to even, I was like, okay, this could be kind of a good teaching lesson on why I didn't really care when I was down so big, and then what I did while I was down. So when we get a chance, you can pull up the first slide.
All right. And for everybody out there, before we dive into the business of it, we want to say for all those who served in our military branches, thank you for your service. It's days like this we love to celebrate you all. We want to stop before we go into it to say we do appreciate everything you do for this country. All right. Now, with that being said, we are going to dive into it. I would suggest at this moment, if you want to share this with somebody, if you also want to pull up your portfolio. When we do these lives, this is a great opportunity to actually pull your portfolio and revisit it, especially with today's topic, because I'm sure there's some things in your portfolio that you're going to look at and think, did I should I have kept it? Should I have gotten rid of it? I didn't know I had it. And just a shout out for anybody who going to the end of the year tax planning as it relates to your actual portfolio. It is important understanding short-term, long-term gains. It's Q4. We're going to the end of the year. If you want to connect with the law office of Attorney Beverly Winstead, she's a tax attorney, and she actually does tax planning. Also, you can visit Premier Group Services and their CPA firm. They also do tax planning. But this is that period where you really need to start deciding what are you going to do as it relates to just your overall money situation. So with that being said, let's jump into the business. All right.
Okay. So what you're looking at here, and for everyone's listening on the podcast, what we have on the screen is a chart of Darden Restaurants, ticker symbol DRI. So I bought Darden back on, and I have it marked here, on February 27th of this year, 2020. I bought Darden for, I know some slides a little small. I bought it for $122.39. And this was on 2/27/20 of this year. Bought it for that price, right? So what you're looking at, people that can see it, what you're looking at on this chart, each bar represents 1 week. So these aren't daily bars, these are weekly bars.
So real quick, For
Huh?
anybody who's wondering what this is what's considered a candlestick chart. So, the candlestick, each of those areas is what Leon said, it shows the duration. So, again, if you listen to the podcast, we're looking at the candlestick chart starting on February 27th, 2020. And it's going to go, Leon, is this going to today?
It goes out through yesterday.
Okay. And so that chart goes from February 27th, 2020 to November the 10th, 2020.
Yep. So like I said, I bought Darden on 2/27/20 of this year. And of course, 2/27, all of us know none of us knew about COVID that much. It was starting to come in, we were starting to hear stories about it, but it hadn't affected us really at all. And then 2 weeks later, you see on the chart, and people that are watching, there's a huge red candlestick going down. And over the next month, the market dropped 34%, 35% in 1 month. Darden, this stock here, dropped from 120, 122 is which I bought it at, down to $26 in 1 month. I lost 80% of my investment in 1 month.
Wait. You lost 80% of the
Sorry. And I made a correction on the thing. I was down. Yes, let me correct it. And I changed it on the chart. I changed on the graphic too. I was down 80%. I didn't lose 80%. I was down 80% of my investment. So to put that in context, if this was a $100,000 investment I had made in Darden, back on the 27th, after a month, I would have been down $80,000. I would have been down 80%. Put it in another term, that's $20,000 I would have lost every week for 4 weeks for a month. I would have lost $20,000. I would have been losing $20,000 per week for 4 weeks in an entire month to go from $100,000 down to just $20,000. I would have lost $80,000 in 1 month. And that is hard to stomach, right? Now, again, I'm using the analogy of $80,000. Of $100,000, just kind of give numbers and give kind of some big numbers so everyone can kind of get their head around it. But really just look at the being down 80%. In 2 weeks, I went from being, at even money down 80%. Now, question is, what did I do? Did I sell? Did I buy more? Did I panic out? What did I do? I effectively did absolutely nothing. And there are two reasons why I did nothing. So during that month period from mid-February to mid-March, I know people, and Brent does too, we know people that were panicking, right? The market imploded 35%. The market did. Individual stocks dropped, 50, 60, 70, over 100%. Some stocks went close to zero. My position went down 80% here. So there was a lot of panic in that month time. And a lot of people sold, a lot of people panicked out. Some people may have bought more and then took an even bigger loss and got out with it, double the loss. There was a lot of stuff going on during that between February and March time period when the market just absolutely collapsed. So what did I do? Like I said, I did nothing. And there are two reasons why I did absolutely nothing. First one is I know what I own, right? And you can say, well, what do you mean by that? So what I mean by that is, as Brent and I always say, do your research, right? Before you get into a stock, if you know the stock somewhat, if you know the stock a little bit, if you know the stock a lot, still do your research. Because I knew when I bought Darden on February 27th, I knew exactly what I was buying into. I was buying into a company that over the last 3 years has grown revenues 7.1%, sales 7.1%, and has grown profits 71.8% over the last 3 years on average. So we're talking about a company as big as Darden Restaurants that's growing almost like a tech company, growing its earnings almost like a tech company at 72% on average the last 3 years. That's a huge number for a restaurant company and just a company in general. So I knew going in what I was getting into. So now when the market absolutely collapsed and fell apart, I didn't panic. I didn't move. I didn't do anything because I knew, one, Darden is a very, very strong company. I knew its sales, I knew its revenue, and I knew its balance sheet was all solid, right? And we all know that the market was down because of COVID, right? So we all knew the context of why the market was down. So nothing fundamentally had changed about Darden's business outside the economy shutting down all businesses. But as we all know, at some point we'll get on the other side of COVID, and life will go back to normal at some point. When, I don't know, but at some point. So that's another reason why I was not worried at all about my investment.
So for many of you all are thinking, okay, yeah, you knew all those things, but you guys run an investment company, so not everybody knows revenue. Not everyone knows growth year over year for a company. this is all public information.
Mhm.
So if you all were to go to Yahoo Finance, is a great resource. You can Google it. I mean, we Google everything these days. But also inside of almost everybody's brokerage account, there's a little magnifying glass, and in that search bar, if you put in the company's name and or ticker symbol, you can find financials, you can find news, you can find competitors. So in most people's situation, not to go overly technical where you start to kind of gloss out like, okay, I got it, but what about me? You can run the same type of analysis on your company, and it doesn't have to be deeply quantitative or qualitative. You can kind of be in the middle, right? Spend some time. Make today the day you spend some time with your portfolio. Get in, just search it. And if you already own the stock and it's in your portfolio, you can normally click on the ticker symbol and then get a detailed report of like everything about that company. Most of what Leon and I talk about is all public information. There is not some secret little place where we get this information from that is not privy to everyone. It is. And then additionally, if you can't find it, we've talked about this before. Many of the bigger companies have what's called investor relations lines. You can find the number, you can search for it, you can, again, Google that. Investor relations number for X company, you fill in the X. Talk to them, call and say, you know what, I was just wondering what was revenue last year? What was revenue? Where can I find more information from you all? Is there anything you can send me? These numbers and these divisions are set up specifically to address the concerns of stockholders. And if you own the stock, you can pick up the phone. And so again, we say this because we're trying to demystify the whole shroud of like confusion that is in the stock market, or to make you think, if I'm not hiring somebody to run asset allocation modules or Monte Carlo reports, I'll never be able to figure it out. You will. You can call them and it's free. It's part of what the services you receive as being an owner in that company. And actually, even if you don't own the company, you normally can call the investor relations line and ask questions about the stock. But bigger point to what we're saying right now is, for everybody listening, if you know what's in your portfolio and then COVID hits, and then you just reasonably and rationally step back and say, okay, what's happening? Did anything fundamentally change in my company's structure, in their philosophy, in their management, in their financial structure? And if the answer to all those are no, then you just have to figure out, what do you want to do? And in most cases, if you understood your strategy going in, you can continue to execute it throughout a downturn like this. If you have no strategy and this happens, you have nothing to hold on to. So your emotion is going to kick in. Emotion is going to supersede every other rational thought that you have. And you don't want that to happen. Like Leon said, when he bought this, he knew what it was. He knew what he was buying. He knew the company's internal workings, like the financials, management, growth. And so when COVID hit, rationally, he also knew what COVID was. But none of us knew the impact it would have. None of us. Leon, nor myself, nor anybody else. If they say they knew, they didn't. And so, because we still don't know what's going to happen, even with this thought of a 90% cure or vaccine, we still don't know what's going to happen. And so, predicting out the market really is just a matter of you understanding what you want to do, or how much of this you want to hold inside of your portfolio. Like, what is the percentage of your portfolio you want to, allocate to this particular stock, or whatever stock it is you're looking at home, or if you listen to the podcast. So Lee, what's the next one?
Yeah, no. So okay, so as I was saying, I was down 80% on this particular trade. Like I said, I did nothing. I didn't move because, again, I was saying there were two reasons I didn't. One, because I knew what I owned. I knew what I bought. Right? Know what you're buying. No, when we say that, and we don't just mean like know the name. Like, no, you've heard of Home Depot, you've heard of Microsoft. That's a great place to start. But I always use the example of Walgreens. We all know. Well, I would say most of us know Walgreens as the corner pharmacy. And some people say, okay, that's solid company, been around forever. Let me buy it. Well, Walgreens is down 45 or 50% over the last 2 years. So if somebody just jumped in Walgreens 2 years ago and said, hey, I'm gonna buy Walgreens because I know it, you lost half your money. You lost half your money, right? And the reasons behind that, it's not just because Walgreens is a bad company. It's because Walgreens sales, earnings, profits, growth projections, things like that are terrible. They just are. So the company has suffered the last 2 years, and the company's been almost cut in half over the last 2 to 4 years. So just knowing a company, just being aware of a company is not enough. That's why Brent and I would say, do your research. Now it is right now, it is hard. It can be kind of hard to find a lot of this information, but the two I always quote, which are sales and profits, as Brent said, you can find anywhere. You can go to Google Finance and go to the financials tab, and you can find this. You can find this information. It's public information. I look at a ton of other numbers, but those are the two that are easiest to find for most people. And a lot of times are really all you need, because ultimately that's what a company boils down to, is its sales and its profits. Okay, so back to the chart. So I was down 80%. On that one. I was down 80%. I did nothing, right? I did absolutely nothing. So because again, I knew what I bought. Another reason I didn't do anything was because how I sized the trade. And as Brent and I often see with new investors, investors they fall in love with a company. They fall in love with the company's story, like Tesla, Apple, Microsoft. Like they really get jazzed up about these companies. They want to buy like tons of shares, right? Well, the problem is if you buy tons of shares in one company and this happens to your company, that stock, it drops 80%, your portfolio is shot. It's called what they call, you've blown your account, right? And so what I do to avoid that, and the reason this 80% drop didn't really affect me at all, I have a rule that I take a certain percentage. So whatever my account balance is, let's say 100,000, I'll take a certain percentage of that 100,000, and I'll only invest that amount of money into any one position. So example is, let's say for me it's 10%, right? So if it's $100,000, and I'm only going to take 10% of that $100,000 and invest it in any one position, that means I'm going to invest what is 10% of 100,000? 1,000? 10,000. No, 10,000. Yeah, 10,000. So that means I'm only going to take $10,000, no matter what the price is. If it's Google at $2,000, or if it's ABC company at $11, I'm only investing $10,000, and that's it. No, I don't care how many shares it buys me, because what I'm doing is I'm slicing my portfolio up so that no one position can really drastically affect my account. So like when I was down 80% in this stock, I mean, my whole account was down. I mean, everybody's was during the drop. But my account wasn't down 80% because I was down 80% in this one stock, but all my other portfolio was like 20 to 25 stocks. While they were most of them were down, the market was down about 35%. I was down like, I think 38%, right around 40%. So I was down a little more than the market, but I was not down 80% like this one stock, because again, my portfolio was spread out amongst a bunch of 20 to 25 stocks, where one stock at only 6%, 6 to 10% of my portfolio can't really hurt me. So that's why I did nothing. And I didn't even notice I was down 80% in the stock until I actually looked at it. Because again, it's a small enough portion of my portfolio that it didn't destroy or blow my account, as they call it. So now moving to the right of this chart. So you see there now where I have, it says, stay on this one more time. So in the chart I have where I'm showing stock pick 527.20. So this was actually, DRI was actually my stock pick of the week on our podcast on 5/27 of this year, May 27th of this year. And at the time it was trading at 81.56, right? Now think about it. I bought a stock that I was down, one point I was down 80% in the stock. And then it had recovered about half. So I was still down about 40% in the stock on my original investment. And I still went back in and bought it. And it was my stock pick, and I bought more of it. Again, the reason was because it was a small enough portion of my portfolio that it didn't hurt my account. And two, I knew what I bought, right? I knew at the time the fundamentals of the company. And as I said, once COVID's over, we're eventually going to get back to some normalcy, and people will start, to go out to restaurants, eat again. I mean, we all would love to get out right now. We all want to go out and have a drink and go have dinner with some friends. It's pent up, right? So we know restaurants are going to come back. And since I picked it on 5/27, the stock is up 34% in 6 months, right? So when I bought it, it was at $81. When I when I picked it at $81, I think today it closed at like 108 or something. So the stock is up 34% since I picked it. And I'm almost back to break even on my original investment. So I say all that to say, this is a good example of why, even when a stock absolutely implodes and could destroy your account, if you know what you bought, again, know the fundamentals behind the company, and the position is sized relative to your account size, that it will not hurt your account, it's not really a big deal. Like I said, this is one position of 20 some odd in my portfolio. And I think at the time, it may have been like 8% of my account. Was no big deal. I barely even noticed it. So I just want to make that point. That was the point of this slide and of this live today, was that one, know what you buy and two, size it appropriately to your account. Do not go all in at 50, 60, 70% of your account all in one stock. Bring it down well below 10%. And then another thing it does actually is it kind of forces you to diversify, because if you go all in on, say, 3 stocks, right? Say you have $100,000, you put like 33% in each one. If one of those stocks takes a hit like this, your account is going to feel it badly. Whereas if you're saying, okay, I'm only going to put 10% of my account balance in any one stock at $100,000, you by default have to go into 10 different positions, right? So this kind of rule kind of forces you to diversify your account by default by following this particular rule. Right. And so unless you have something, but yeah, you can go to slide 2 now. So the takeaways, the main point of this is know what you own, right? Do your research. As I said, we've all heard of Walgreens, but it's down between 35 and 50% over the last 2 years, right? So just because it's a big name, just because it's a household name, does not mean it's a good investment. So do your research. And when we say fundamentals, like we're always talking about sales, profits, management, balance sheet, things like that. The easiest to define, just look for sales or sometimes they call it revenue, or profits, or sometimes they call it earnings. They're the 2 easiest to find. To me, they're the most important. I do look at other ones, but I always quote those 2 because to me, they're the most important. So when you're doing research and you're looking for, if you want to just hang on to 2 different data points, just pull those 2. You can find them, as Brent said, they're public information. You can find them anywhere. Second point, main point, is size the investment appropriate to your account size. The amount invested in any one stock position shouldn't adversely affect your account if the stock goes to 0. Now, going to 0 is kind of a, that's an extreme. But as we always say, use risk capital and assume any investment that you do will go to 0, right? So again, $100,000 investment, if you're only doing 8%, that means you're investing $8,000. If you can afford to lose that in this investment account and the stock goes to 0, you're fine. If $8,000 too much, lower it to like 3%. If you can afford to lose $3,000 in this account, you're fine. This will help you sleep at night. So it's not stressful. And that's why, again, when that stock was down 80% on me, I barely even noticed it because it was such a small portion of my portfolio. But my portfolio was spread out amongst like 20 to 25 different companies. And last, as I was saying, it's a good idea if and this is my strategy. Not saying it's the best, not saying it's for you, but it's something to think about, of taking a percentage of your account balance and using that 1% and holding that percentage. Don't change it, right? So if you say 3%, go with 3%. Because if you start changing the percentage, then that's when emotion is kind of getting into, and that's what you want to eliminate wholly is emotion from investing. So if you say 3%, it's going to be 3% of your account balance. Stick to that. You may feel like, oh, you're not buying enough shares. Well, that means you need to buy more stocks, right, and more diversification of your portfolio. So those are the three main takeaways.
Cool. So for anybody who has questions, we're happy to answer any questions you have. But for today, really the moral of the story is check your accounts, see what you have, understand why you have it. And again, this is a strategy for anybody who it resonates to, right? And for some of you all just don't know what strategy even means. So we want to give you kind of a take on a strategy to manage your portfolio that makes sense, that you can easily digestible and also executionable. So if you have questions, please put it into the chat. We will answer any we can. If you're listening to the podcast and you think, oh, you know what? I have a question. If you go to www.ieapodcast.com, you can also access a question in the podcast, make a comment, and we will get to it as we can. For everybody, let me see. Hold up. I have a question.
I just want to make one other kind of mental visual point is that, like I said, I was once down 80% in the position. On $100,000, that would be down $80,000, right? I mean, just a ridiculous amount of money. On $6,000, you'd only be down $4,800, right? So look at that difference. If the max you're gonna do is 6% and you're down 80%, you're only down $4,800 in a $100,000 account. So these are money management things. These are things that will save you from market. When the market throws up on itself like it did during COVID, you're saved by that. If you lose $4,800 in a $100,000 account, not a big deal. But if you lose $80,000 in a $100,000 account, that's your account's blown. You're decimated. I mean, and you probably wouldn't even hold on to you lost $80,000 at 30, 40, 50%. You're going to bail because you just can't take the stress. So I just want to kind of make that distinction that that's what picking a low percentage of your account balance will do. It'll save you from yourself, and it'll save that emotional stress that we can all go through.
All right. One of the questions is, are we looking for increased sales and profit margins? The question is, yes. You always want to see increased sales, but more importantly, you got to understand too, sales aren't directly correlated to profit, right? Increased profit margins is more important because you can have increased sales, but if your expenses are increasing relative to sales, then it's a net zero effect. And how many individual investments should one have in their portfolio? It depends on your strategy. It depends on how you manage your account. If you're managing it like Leon, you're only going to have divide 10% or 6% from the total amount that you have invested, and that's how many stocks you own. So if that's the strategy you choose to use, that's it. So it just depends on how you're managing your portfolio. And you heard people say diversity over industries. Any recommendations for allocation percentages per industry? That's actually a great question. It depends on what you're trying to accomplish and your investment style. So for Leon, since you're talking about your style today, I'll let you answer that question.
Yeah. So for me, I do. So like Brian said, it depends. I mean, everything depends. Like what I do may not be for you, right? But for me, I only do, so the max I'll do for any sector is 30%. So when and for me right now, technology for me, because it's just leading the market. That's my number one sector is technology. So the max I'll do per sector is 30%. And then, as I said before, per individual stock, I'll do anywhere from 5 to 10% per individual stock. But once I get to, if I say 5 stocks in the tech sector, takes my portfolio 30% technology, I'll then stop there, and then I'll move over to say, financials or retail or industrials. But I'll stop that one sector at the top sector at 30%, and then individual stocks between 5 and 10%.
Okay, and then there's a question: Are 10 to 15? I'm gonna change it to a question. Are 10 to 15 individual stocks good for diversity? It doesn't. It's not 10 to 15 is the number. It depends on the size of your portfolio. There are people inside of IEA that have multi-million-dollar accounts, so they're going to have far more than 10 to 15 positions. Also, I know people with smaller accounts that have more than 10 to 15 positions. It just depends on what you're trying to do and how you're trying to diversify. If you have 10 to 15 positions, but you're overweighted in a particular sector or even in a particular stock, because what Leon is talking about is individual stock risk. And if you have individual stock risk and something happens because you're overweighted, you're 50% in the stock, and all of a sudden that happens, that chart happens to your stock, it goes down 80%, more than likely emotions are going to kick in and you're going to bail at the bottom. And if you're at the bottom, exactly, you're bailing somewhere on your way down, and you're not going to be there for the recovery. And what we hear a lot is people who they get hurt in the market, and their thought is, well, I'll just get back in when it's climbing up, when it's climbing again. You don't know it's climbing until it's already climbed. And we've said this time and time again, if you miss 10 days in the 10 of the best days throughout 1 year, if you miss 10 of the best days, I think it's actually, is it 10? Is it 10, Leon?
Yes, I believe it's 10, yeah.
Yeah, 10 days on a climb, you're actually, it's the equivalent of missing like 3 years of being in that stock. And because we don't know these things, we don't feel it, but we're telling you. So time in the market can hurt you. And if you're overweighted in the industry, I 100% agree with Leon. When that company begins to have some trouble, most people initial response is, well, let me see what happens. And then all of a sudden it goes fast. And then they feel like they have no other choice but to bail out.
Yep. And we've all done it. We've all been in a stock where we're like, it can't go any lower. It can't keep going down. Like, it's going to turn soon. It cannot break 30. It cannot break 20. Next you turn around, that thing is at $10. And you're down like 60, 70%. Right. And as I showed with the example that happened to me, I didn't even know I was down 80% in the stock because it was such a small percentage of my portfolio that it didn't really even affect me. I mean, it sucked when I finally was aware and I was down 80%. But again, I knew what I bought. I knew it was because of COVID. I knew it was a strong company. I knew the fundamentals. And as the chart showed, I'm basically almost back to break even. And then my stop pick from when I picked DRI in May, since then it's up 34%. So, again, it comes back to doing, and like Brent said, all this stuff is out there, but you still got to do some research, right? Like research is hard and it sucks, but investing is in some ways kind of like a side hustle business. You got to put some time into it. If not, you can lose a lot of money. And I used to lose a lot of money before when I was kind of like day trading and doing a lot of technical things, and not doing like really fundamental research and staying long term. Yeah, I lost money like crazy. That's why that's what Brent, I was saying, like, we're giving our experiences to everyone, the stuff that we've been through. So, other people won't, especially us, won't have to, go through it.
Yeah. And I'll tell you all, for anybody who's been following IA for more than 4 months, might remember when I personally showed you all a stock that went to zero. And it was a real estate investment trust. And this particular company was paying a dividend of like, I think it was 13% at its high. And I was just in love with the dividend. That's all I checked. I no longer even check the stock price. I used to just check the dividend. And it turns out, this company was borrowing money to pay the dividend, which was driving it further in debt until all of a sudden it just disappeared one day. And, it was the company that I never thought could go to zero because it was a dividend paying company, because I didn't fully do my research. I fell in love with the dividend portion of it. And that stopped. I didn't do my due diligence. You all should always do due diligence. But this is also the cool part about it is it never affected my account. I mean, it affected my account, but like it was such a small position. And because I purchased it because I just wanted the dividend, I only put enough in to kind of track the stock for a while until I got familiar with it. And so it wasn't a huge part of my portfolio mix. So it might have been less than 3%. In that case, it didn't matter when it went to zero. It was more like a little bit of a laugh, learning lesson. Let's keep it moving. Now, if I had put everything, the whole house in the sink into that stock, because I was like, whoa, it's paying a 13% dividend. And, maybe I was a dividend chaser, or, I just thought anything with the dividend has to be a strong company. And I went to create what would be, again, single stock risk. And I just put it thinking, oh, well, at least I'm getting this dividend, which is killing the bank. And all of a sudden the stock went to nothing, literally. I think the last time Leon and I checked during that live, it was at 0.0001.
It was like, I mean, it's crazy thing, it's still trading, but it was like less than a penny.
It got delisted.
Oh, it did? Okay. All right.
Yeah. So, and that's a whole other thing about delisting and listing. But, for everybody today, just know what's in your portfolio. If you are properly diversified, things hurt less. Now, again, it depends on, really your strategy. Because if you take a millionaire who's, this is just play money, $1 million is play money for them, or multimillionaire and $1 million is play money, and they put it in a stock. Now, granted, we might think that's the dumbest thing in the world, but if they can handle it and they don't mind single stock risk, to each their own. But, it's no strategy in that. And it's not something that we readily suggest to anybody who is, a new trader, even experienced traders. I wouldn't recommend that to really anybody. So have a system, know your system, be willing to change your system, because, change is good. You'll learn things as you get more familiar with the markets, as you get more familiar with yourself. You'll learn new things about you, and then the market, and just figure out where's your sweet spot. So with that being said, I think we answered, I'm just checking to make sure we answered all the questions. And say you can't time the market, you really can't. And
oh, no, not at all.
If you try to time the market, you're going to meet people who have this skill. And I'm only saying this because the question was asked. I really don't want to go too deep into it. But you will find people that have found a really good system for how they get in and out the market. We are not knocking that at all. However, we're saying that is few and far in between. It is not the norm. And not only that, you don't know what their risk capital situation looks like. So when you hear people tell these stories about, oh, they're looking for resistance, and once it breaks through resistance, they're going to go ceilings, floors, all these things. You can try to play that game if you like, but we're simply saying it's easier, it's safer to have a buy hold strategy where you're buying well-positioned companies with strong financials, strong management, strong growth potential in an industry that's growing. Or sometimes you want to be in an industry that's stagnant because markets are cyclical. And so when one's up, another's down. So you don't always want to go for the winner. Sometimes you need to position yourself in the things that don't look great, because when the market swings the other way, similar to all the travel stocks that we talked about, you know, when everything hit in tech and then travel stocks were winning, and also finance, that was a great situation for those that were positioned properly. So I think we answered all the questions. Did you want to say anything about any of the questions, Lee?
No, just like I said, generally, you know, size your positions according to your account and know what you own. That's the biggest one, is understand, do your research, know what you own, because again, if you see something that's down 80% and you know it's a quality company and you know it's for like an external reason, it's no reason to panic. It may be a reason to even buy more. But you know, panicking out.
Say that.
Say what?
I was waiting for you to say that.
Panicking.
Normally that's what you lead with. Stocks on sale, but you didn't say that.
Oh yeah, I mean that. Yeah, that. Oh, quality companies that are down is that's my game. That's what I do. But as something's falling, I get it. It's painful. It hurts. But as we showed with DRI, that a quality company, even in the middle of a pandemic, that was down 80%, which is now almost back to where it was pre-pandemic, just shows, you know, when you buy quality, you know, eventually they come back.
Yep. So anybody, we've had a number of interests or people interested in joining the IEA from some of these talks, and we are happy to have the new members. Anyone else who's interested in joining, you can find us at www.ieamembers.com. We're getting close to that 100 member mark, so that's kind of awesome. But more importantly, the content and the things that we're doing inside the framework, it seems like it's really having an impact not only on the people in the platform, but their families. So that's, I mean, some of the texts that you all have been sending have been amazing. Also, we got a text the other day that somebody said, Alexa, play Investing Education Podcast, and we came up. So I tested it at my house. So I said, Alexa, play Investing Education Podcast, and it started playing. My daughter freaked out. My wife was like, oh my gosh, how did that happen? So we told you all a while back that Amazon had contacted us about actually listing our podcast. We went through with that process. I didn't even know until the member texted us and told us. So if any of you all have Alexa, you can go to Alexa and say, Alexa, play Investing Education Podcast, Investing Education Podcast, and we should play. So thank you, everybody. And we'll talk to you all next week.
Oh, picks.
Oh, picks. I know Beverly's probably texting right now, dude.
Yeah, dude, you know you about to get it, man.
All right, so Leon, you can go first.
I know what that means.
No, it doesn't mean that.
Oh, it doesn't mean that? Okay.
But I know Beverly's somewhere like, I know they didn't try to stop without.
Right? Yeah. Beverly and Mo.
Yeah, that's the two people who just said something. So,
so my pick is a company. Company's name is Fortive. Ticker symbol is FTV. Fortive. Today closed at $70 even, and it was up 0.29%. So Fortive is a huge industrial conglomerate. So I'm just going to read what they do. So they supply high-tech equipment, components, software, and services to the manufacturing, transportation, and repair markets worldwide. They also have a massive instrumentation business specializing in advanced measurements and monitoring to keep critical infrastructure up and running, which was a mouthful. So basically, from what I got when I kind of did the research, they have they supply. They're not a tech company, but the portion that supplies, like I said, high tech equipment, components, software, yada yada yada. They do have a big tech component, but they're not a tech company. They supply, like I said, these things to governments, cities, and private industry. And like I said, also a big measurement company, a big measurement portion and monitoring portion, which also helps cities. So big, they're just an industrial conglomerate. They're the big stable company. So over the past 3 years, back to my two main data points, they're growing their sales on average 10.8% per year over the past 3 years, and they're growing their profits 39.7% on average the last 3 years. So again, like I would say, growth companies are typically companies that grow their profits 20 to 25% quarter over quarter or year over year, right? Those are considered growth companies, which are typically tech companies. But here you have an industrial conglomerate that's growing its profits year over year over the last 3 years at almost 40%, which is more than double, the quote unquote, which growth companies do. So that's huge. I mean, it's a stable company growing profits at the rate of a growth company. And it does pay a dividend. It's minuscule. It's 0.40%, but it does pay something. So, I mean, this is not a dividend play, but, that's just extra money on the table for the company. So, again, it's Fortive, ticker symbol FTV.
All right. And for me, I picked one we all know and love, United Parcel Service. So
we both went in. I think they're industrial too. We both went industrial today.
For anybody that doesn't know UPS, it's the brown and gold company that delivers everything to everybody all the time. So the ticker symbol for United Parcel Service is UPS, and it last traded at $166 per share, up roughly 1% today. And I want to say it's currently the dividend payout is 2.42%. This company has almost $120 billion market cap. So they are not going anywhere anytime soon. Also, what that does with a market cap that size, it makes them resistant to COVID type environments. And so you want to really have companies that have strong, reserves, similar to what we saw in the travel industry, where they were able to survive simply because they had enough money to either cut their dividend, to not have to take out loans, or not to lay off people immediately. We all had a hit. But when you look at a company like a UPS, when COVID hit, they gained more market share. As we go back to what we hope is a COVID-free environment, people aren't going to stop shipping. It's not going to reduce. Before COVID ever hit, the shipping, well, actually, let's look at Amazon, Shopify, eBay. All these companies were growing in their number of orders being placed before COVID. And so there's always going to be somebody that has to ship these. And I mean, it's pretty simple. I just decided that United Parcels was not going to be the growth play. It's not going to all of a sudden shoot up, but it's consistent. There's not a lot of fluctuation in the stock price. And I think they're going to kind of be the company to endure the test of time. And the ticker symbol again is UPS. All right. Cool. So the stock picks today are United Parcel Service, UPS, and Fortive Corp, ticker symbol FTZ. V. So I must say, as I was saying it, I was like, my dyslexia was like really, like I was zeroing in. I was like, I'm gonna say something wrong because anyway. So the symbol is FTV.
Right.
For everybody watching, it is true. I have dyslexia. I mix up V's and Z's and P's and D's. So
I'm colorblind, so we got all types of
everybody, thank you again for being with us. We look forward to talking to you again next Wednesday, 9 p.m. to give you the best information we can. And if you're listening to the podcast, thank you so much. We're growing. You can now go to Alexa and say, Alexa, play Investing Education Podcast. Not Investing Education Academy, but Investing Education Podcast, and we should play. Thank you for your time, and we see you next week.